Good morning, dear friends. We have been discussing about the various provisions in respect of the capital gain, means computation of income under the head capital gain in Income Tax Act. So far, we have learned that the capital gain shall arise only when there is a transfer of capital asset. If there is no transfer of capital asset, there cannot be any capital gain on that account. We have also learned that what is to be included in the definition of transfer. What are the capital assets? It means what exactly constitutes the capital asset. We have also learned in our earlier discussions, in our earlier lectures, that what is the difference between short-term capital gain and long-term capital gain, and how the short-term and long-term capital gains are to be computed. We also learned the importance of the cost of previous owner to the assessee who has acquired the asset by any of the modes as prescribed under section 49. We also learned that how the cost of an asset is an important as on 1st April 1981 if an assessee has acquired it before 1981. So we learned the computation of capital gain, means short-term capital gain, long-term capital gain. Now we just try to discuss the computation of capital gain in certain special cases. As I mentioned you earlier also in my last discussion, that why there are special cases? Because under the special cases we mean that the method of computing the capital gain is different from what we have discussed in the preceding paragraphs or in the preceding sections or preceding lectures. So the method of computing the capital gain is different. What are those situations? We'll just try to describe the situation like that. The number one situation is the conversion of capital asset into a stock in trade. This is one situation. Another may be the transfer of capital asset to the firm as a capital contribution, transfer of capital asset by a firm on its liquidation, and so on. So there may be situations like that. There may be some special cases like that. So we'll just try to learn some of these special cases, means we'll just try to learn the provisions in respect of some of the important special cases as how we can calculate the capital gain. First case we pick up for our discussion is the conversion of capital asset into stock in trade. In fact, any profit or gain which arises from the transfer of asset by way of converting the same into stock in trade of a business carried on by the assessee is chargeable to tax under the head capital gain, and such income is treated as income of the previous year in which such conversion took place or otherwise transferred by him. So for the purpose of computation of capital gain, the fair market value of the asset on the date of such transfer shall be deemed to be the full value of consideration. It means such a situation may arise when an assessee he converts his capital asset into stock in trade. Stock in trade of a business which is being carried on by him. Number two, for the purpose of valuation of the capital asset on the day on which he just converted the stock in trade, the value of the capital asset shall be the fair market value on that day. Fair market value on the date of conversion. And if there is any capital gain, the liability to pay such capital gain shall arise in the previous year in which such converted stock in trade is sold or otherwise transferred by him. It means if, for example, any particular capital asset has been converted into a stock in trade, say in 2002. But this converted capital asset, which was this stock in trade, in fact, was sold in 2007. It means if there is any gain on account of this particular converted stock in trade, then the tax on that shall arise only in the previous year in which such converted stock in trade is sold or otherwise transferred by him. We'll just try to learn this concept by taking an example. I think then it will be more clear to you. Here, this is the example. In the said example, Mr. X invested rupees 10,000 to acquire 1,000 equity shares of XYZ Limited on 1st March 1988. In January 1998, he started a business of dealing in shares and converts his holding into stock in trade. The market value of the share on the date of conversion was rupees 30 per share, and therefore X credited his capital account with 30,000 and debited the stock in trade account by 30,000. The shares were sold, it means these converted shares were sold in the previous year on 1st December 2005 for a sum of rupees 1,40,000. So in this case, what has happened? One Mr. X, he purchased his share on 1st March 1998. That was the purchase. Now what happened? He just converted these shares in 1998 on 1st January as stock in trade. Now this converted stock in trade, he just sold it in the year 2005. It means 2004, 2005 he sold it. In this case, how do you calculate the capital gain? Just try to learn. First of all, we'll see the market value on the date of conversion. The market value means the market value on the date of conversion was 1st January 1998 and the market value was 30,000. From this market value, we will get the index cost of acquisition because this is a long-term capital asset and accordingly we will have to calculate the long-term capital gain on that. And for calculating the long-term capital gain, the cost of acquisition shall be in terms of the index cost of acquisition. The index cost of acquisition means it would be 22,067 and the capital gain shall be 7,933. So this is the capital gain, but the liability to pay the tax on this capital gain shall arise in the assessment year 2005-2006 when this converted capital asset has been sold. If you kindly see, the subsequent to that, the conversion subsequent to 1998, the asset was sold in 2005. It means the capital gain up to this level would be calculated, and after that it would be business income, and the business income was 1,40,000. So from 1,40,000, the fair market value of the asset was 30,000 because that was the converted value of the asset. So 1,10,000, that would be the business income, means this amount has been on account of the business, carrying on the business, and the capital gain is to the extent of 7,933, and this is the balance. I mean, from this date to this date, the capital gain is there, and that capital gain would be taxable in the assessment year 2005-2006 because it would be reckoned to be as the income for the previous year 2004-2005. So this is the way we can calculate the capital gain in respect of the converted capital asset into a stock in trade. So I think the concept would be quite clear to you. Now we'll just take another special case, which is the capital gain in the case of non-resident. How to compute the capital gain in the case of non-resident? It means for computing the capital gain, first of all, some conditions should be satisfied, only then we can calculate or we can compute the capital gain in this category. The first condition is that the taxpayer is a non-resident. This is the first condition. It means if we want to calculate the capital gain in this category, the taxpayer should be a non-resident. Number 2, such non-resident acquires the shares or debentures of an Indian company, and such shares have been acquired by him by utilizing the foreign currency. This is the second condition. The third condition is the asset may be a short term or a long term. It means the category of asset may be a short term capital asset or a long term capital asset. So if all these three conditions are fulfilled, then we can calculate the capital gain in this category. Now, another thing is that the capital gain which we calculate shall be calculated in the same currency in which the asset was bought, and the benefit of indexation shall not be available in this category. It means no indexation shall be available. Otherwise, the benefit of indexation is available for the purpose of calculating the long-term capital gain. Even otherwise, the indexation is not applicable for calculating the short-term capital gain. And this particular facility or benefit is available for calculating the long-term capital gain. But in this category, if we want to calculate the long-term capital gain, the benefit of indexation shall not be available. So this is one of the major conditions which applies to the non-resident who have acquired the capital asset by utilizing the foreign exchange. So what are the steps for calculating or computing the capital gain? The following are the steps. Rather, the steps are like that. We can categorize the steps into this category. The first of all, the sale consideration. It means when a person sells the asset, because the capital gain, I just told you earlier also, the capital asset will arise, the capital gain will arise only when there is a transfer of asset, transfer of capital asset. So the transfer may be on account of sale, and this sale consideration in Indian currency. If the non-resident, he acquires the sale consideration in Indian currency, then first of all, this sales consideration shall be converted into the average exchange rate. What is the average exchange rate? Average exchange rate is nothing but the average of telegraphic transfer buying rate and telegraphic transfer selling rate. The average will be taken. It means if a particular person has acquired the sales consideration, say, of rupees 1 lakh, then this rupees 1 lakh would be converted to the foreign currency. The foreign currency would be, means it would be converted to the same foreign currency in which it was utilized for purchasing the asset. If the dollars were used for purchasing the assets, then this currency would be converted to the dollar. If the euro was utilized for the purpose of purchasing the asset, then this rupee would be converted into the euro. The second step would be, then the cost of acquisition shall also be converted into the average exchange rate based on the same parameter. Means average would be the telegraphic transfer buying rate and the telegraphic selling rate. Average will calculate. And the third step is, from the cost of consideration, we shall be deducting the average cost of acquisition. If some expenses have been incurred, the same would also be converted to the average foreign exchange rate, and based on that we can calculate the capital gain by converting into the buying rate on the date of transfer. I think the things would be more clear if we just take one example. Here we can explain this concept by taking example. Here X is a non-resident who remits $60,000 to India on August 10, 1990, and the amount is partly utilized on August 20, 1990 for the purchase of 50,000 shares in AVN Limited, an Indian company, at the rate of rupees 6 per share. These shares are sold for rupees 28 per share on April 10, 2006. Find out the capital gain chargeable to tax for the assessment year 2007-2008 on the assumption that the telegraphic transfer, buying and selling rate of US dollar adopted by the State Bank of India is as follows. So these are the rates. The buying rate on August 10, 1990 was 18 rupees 30 paise and the selling rate was 19.10 per dollar, and on August 1990 the buying rate was 18.40 and the selling rate was rupees 19.30 per dollar, and on March 2007 the buying rate was 45.90 rupees 45.90 and the selling rate was 46.40 per US dollar. So this is the data which is given. Now how we would calculate the capital gain? We can see it by this solution. First of all, because I just told you earlier that all the sales consideration are the cost of acquisition that has to be converted into the average exchange rate. So the average rate on August 20, 1990 would be 18.85, means the average would be 18.85, and the selling rate would be on March 10, 2007 the average exchange rate would be 46.15. How this has come? 18.85 and 46.15, because if you just see it, the buying rate was 18.30 plus 19.10 divided by 2. Based on that, on March 10 also, this is a rate on, and on 10th March 2007, the telegraphic transfer buying rate was 45.90 and selling was 46.40 divided by 2. That would be equal to this, and this would be the average rate would be this. So this is the average exchange rate. So the amount of capital gain would be calculated as under. The sales consideration means he has just sold the share at the rate of 28 rupees on 10th March 2007. 50,000 shares are there. So the total sales consideration in terms of rupee would be 14 lakhs, and we will just convert this 14 lakhs into dollars, because the conversion would be based on the average exchange rate. So based on the average exchange rate, the sales consideration shall be 30,335.86 US dollars. This is sales consideration. From this sales consideration, we shall be deducting the cost of acquisition. The cost of acquisition means he just acquired the shares at rupees 6 per share. The cost of acquisition in terms of the Indian currency is 3 lakhs, and if we just convert it based on the average exchange rate, it would be 15,915.12. Please remember it. While calculating the capital gain, no benefit of indexation is applicable in this category. So the long-term capital gain shall be 14,420.74 US dollars, and that is the long-term capital gain in terms of the foreign currency, in terms of the dollar. Now, long-term capital gain in terms of the foreign currency would be, means this 14,420.74 would be multiplied by the TT buying rate. The TT buying rate was 45.90. Because remember, in this case, ultimately, while calculating the capital gain, here we shall convert it by buying rate. Here we will not take into account the average rate. So the long-term capital gain in Indian currency would be 6,61,912. So this is the way we can calculate the capital gain in respect of non-resident. I think if you just practice at your homes, for more and more questions, the things would be, the concept would be more clear to you. In our next lecture, we'll just proceed with some other special cases. Thank you very much.